Alright, hey traders, Julian Marchese here. Today is July 26th, 2012, and in this video I'm going to give you guys a market update, what I think the markets are going to do over the next couple of days to weeks, and my current positions trying to profit on this. I basically have a position in mostly every market, every major market, at least in the United States. Discounting currencies, obviously. I currently have a bearish picture on basically risk assets as a whole, and that includes equity, commodities, all commodities at this point, including metals. The euro, Aussie, Canadian, and long bonds and long quality, and that would be long, bonds, long US dollars, etc. So right now I have a bearish picture on risk on assets, and in previous videos and in my market posts I've kind of explained why. One reason why is market sentiment right now seems to be pretty bleak in the internals, at least in equity markets. We look at a relationship I like to look at, which is the XLY versus the XLP. And what this gives us is a comparison between discretionary and staples. So Y being discretionary, consumer discretionary stocks, and XLP being consumer staple stocks. Basically what we assume is that during good times in the economy, consumer discretionary stocks will be bought more than consumer staple stocks, and obviously that's because people need to buy consumer staple goods all the time, no matter the current market environment. And discretionary stocks includes more luxury goods and stuff like that. So those are companies that tend to outperform during good times. So these type of spreads, these type of sentiment indicators I use are great for not only just trying to get a gauge on what the stock market should do, but basically the economy as a whole, because this is really an economic viewpoint. You're looking at which companies are doing better, and that will give you a tell as to what sector of the economy is doing better, or if the economy is doing good as a whole. So that relationship between discretionary and staples is a great one to give a tell on how the economy is doing. One that I like to use for what investors are doing is the spread between the Russell 2000 and the S&P 500. Now, this spread shows basically risk tolerance. So instead of the discretionary to staple spread showing us weakness and strength in the economy, this spread shows us the investor's appetite for risk. So we're comparing a riskier equity index to a more stable equity index, which is the S&P 500. So you can see that the Russell 2000 has been underperforming the S&P since the start of the month, and quite consistently. So that's indicating to me that investors are pulling out of risky stocks and putting them into more stable dividend stocks. Now this doesn't mean that stocks should go down. All this means is that investors are becoming more cautious as to where they want to put their money. So that's another heads up that I've seen in the market, and you can see this spread has been underperforming for quite a while. But it's recently accelerated, so that's what's kind of making me watch this a little more closer. So today we had comments out Draghi, basically ECB, basically saying that they're prepared to do anything possible in their mandate to save the euro, to keep the euro together. So that's obviously huge for the markets. You can see the euro right here having a nice pop. I've actually hedged all my shorts in risk through the euro, and I cut a lot of my shorts for risk yesterday. So I'm actually basically flat today, even though overall my risk, I am centered to the downside. So I'm basically flat right now, which is great. I was expecting at least a bit of a loss today. I think it majorly had to do with I cut some risk in oil. I've been cutting risk yesterday, and I also did the day before that. After this big drop, I really captured that drop. That was a really nice move. I continue to be long the same amount of treasuries. I think that treasuries over the longer run are going to continue to go higher due to the fact that no matter what central banks do, well, actually, central banks will help this trade. Basically, it looks to me like a win-win scenario. If the central banks don't do anything, stocks are going to sell off. The global economy is no question weakening right now, especially in Europe and Asia, and that's going to cause spillover into the United States. So with all that happening, and say the Federal Reserve doesn't intervene, we're going to see flight to quality continue. If we do see the Federal Reserve intervene, they're going to buy treasuries, so both ways are going to cause a rally in treasuries. So that's why I continue to be long treasuries. Unless something significant changes in the underlying conditions, I have to be long treasuries, and that continues to be a great trade. So that's one of the only positions that I actually have as a core position that I'm holding for quite a while. So I'm also short, once again, oil and copper. These are great vehicles to trade the global economy as they are heavily consumed by almost every country around the world are heavily consumed, and as they make products, and it's used in manufacturing quite a lot. So when oil goes down and copper goes down, that means that there's more supply than demand for those commodities around the world. And if there's more supply than demand, then that would mean that the global economy is not expanding at the same rate as before, or isn't expanding at all. So I believe, as my picture for the global economy continues to be bearish, I continue to be short copper and oil. I wouldn't call these a core position in copper and oil. Potentially copper would be more of a core position. I haven't actually maneuvered around that. Oil is a little more volatile, so I do maneuver in and out of oil a lot more. But yeah, let's say copper is a core position on the economy as well. Should things continue to do worse, copper should underperform more. Another metal that I like to use is U.S. steel. I am short a little bit of U.S. steel, and U.S. Steel is a company that deals in steel, so it actually tends to outperform when global commodities are doing well, and vice versa. So oil, copper, and U.S. steel are great trades on the global economy, and you can see how poorly U.S. steel has been doing. And then lastly, the stock market, which is the most I wouldn't say volatile, but jumpy markets right now. You can see we haven't made any progress really in the past 3 months. We've just been going up and down. Obviously, I've had my most experience in the stock market. I know the stock market much better than any other market. And as many of you may know, I like to maneuver in and out of my positions in U.S. stocks quite a bit because it's so rotational. Basically, the S&P 500, for example, is a great trade to hold for a couple of days, get out, change directions, and continue that pattern. It usually does quite well. So bottom line is that I like to maneuver in and out positions in the S&P. I am basically flat S&Ps right now, slightly short, very little. However, I would like to get on potentially some today. I think today might be a good sell-off. Because remember, the comments we've heard overnight has sent equity futures much higher. You can see right here, large move overnight. That's basically that's that's Mario Draghi basically saying that they're going to do whatever it takes, but we need to see that happen. So that's only a statement. So until we see any action being taken, I think we're going to sell off this large rally we've had. I think we're going to come in unless we see some sort of action over the next couple of days. That's the only thing. It's the only scenario I really see here, unless people continue to buy on hope, which is definitely a possibility to consider, and we've seen that in the past. So once again, to review, short risk, core position, short copper, and long bonds. As a trade on bond trade is on money flows around the world and where investors have to put their money. Trade on copper is just on the global economy, short global economy. And all the other markets are just to trade around in the meantime. Also, I'm not sure if I mentioned in this video, but Euro I'm using as a hedge, as I believe, well, yes, I did mention this, but I didn't explain why. I'm using the Euro as a hedge because it's been beaten up the most of any other market that I could think of, at least consistently down, 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 no real major bounces. And we have massive short positions in this. So at some point, we will see a short squeeze in the Euro, and I think it's going to outperform other markets. So that's why I chose to use my hedge in Euro, or I guess the better term to put it would be short US dollars. So, yeah, that's what I have on right now. That's what I'm looking for in the markets, looking for continued downside action. Hope you enjoyed this video.